Good morning from La Paz, Bolivia, South America. We hope you're doing good. Ivan, how you doing?
I'm doing good, thank you. How are you?
I'm doing good. So we are letting you in on a conversation. It's just three people. It's Ivan, it's me, and it's you. It's raw. We're not here for production, trying to make this go viral. We're not going to be doing a lot of edits on this video because it's just a conversation with us three. So we're going to walk you through how Ivan trades, but before we get into the expert mode, we're going to start with the very basics. So we assume that a decent amount of people that are coming in, that some of you may know absolutely nothing. And if you do happen to know more than the basics, feel free to skip to another part of the video. But we're gonna kind of go through the basics and then an intermediate, and then it's gonna lead to the highly valuable stuff, which is how he trades very prudently and constantly is making profits, not to get rich, but just to make a living with a very sound system and some strategies. So let's get into it. We're just gonna start with the very basics. Our viewer, we assume in this moment, knows nothing. So how would you break down, Ivan, the very basics of the stock market and stocks, owning stocks, etc.?
Well, the basics are that there's companies out there and they need to raise money, so they sell partial or ownership of their company to the public. The public buys the stocks, which is partial ownership of a company, and you can hold on to it and sell it another time for a profit. So that's basically what it is, partial ownership.
So how would they make a profit? Like, how does that work?
Okay, well, let's use like an example. Let's say there's company X, and they issued 1,000 shares, for example, and you bought 100 shares. Okay, so you bought 100 shares for $100. So basically, you just invested $10,000 of your money. You have partial ownership of that company, and let's say that company's trading at $100 a share. If the stock price of that company goes up to $104 a share, well, then you've just earned $4 on every share that you own.
Nice, good explanation. So the value of companies can go up and down, and the people that have a piece of the pie, their piece can also go up and down in value with that, right?
Exactly.
Very nice. So what else would a basic person need, like a person need to know about the basics of stocks and stock market? Anything else that you can think of?
Well, like it doesn't hurt to do some research on the company. And a free resource, what I use is Yahoo Finance. So I'll open up my Yahoo Finance app and I will research a company. I will have a look at how many shares this company is trading, at what price. And I will look at what industry they're in, like are they in tech, banking, and I will look at all this information before making my decision.
Nice. All right. So with that being said, you've said something interesting before about it being risky investing in companies that are, let's say, sketchy, or maybe they're just less
Yeah.
reputable and they're smaller. They're why do people want to try to stay away from that for the most part usually?
Because those companies are not established yet. They don't have a track record. They don't have as much of a track record, and we don't know if they're going to survive. But companies like Apple, Amazon, Costco, like all these big players, they've been around for a while, so they have a proven track record. So we know they're going to stay. The challenge is you have to figure out when are you going to buy this stock. So if you buy it, you have to be ready for the position to move against you. So maybe the stock will go down. But if it's a good company, they usually recover, and over time they are profitable. You can make profits from these stocks of such companies.
That's a good point. So yeah, I'll put this in terms that helps me to understand, and maybe our friends watching will understand this as well. But like, imagine if they say you have some money and you want to invest in a company. Would you feel that it's safer to invest your money in a company like Amazon, or would you feel that it's safer to, or would you prefer to invest your money in, some kid that just started selling hot dogs on the side of the street, and you have $1,000 to, or let's say $3,000, and you're like, hey kid, I'm gonna give you $3,000, but I want part of your company. You better make the value of your company go up, start generating lots of profit so we both make money. Yeah, that kid could technically turn his hot dog stand into a multi-million-dollar hot dog, chain.
It could happen.
But the risk,
It depends, and you will learn this about yourself as you go through this journey. What kind of a trade? Are you a trader? Are you a speculator? So it depends what you want to do. But as you're starting out, I would focus on established companies that have been around for a while. They tend to be a little bit more expensive, but your money is relatively safe. I mean, provided that we don't have another repeat of COVID or whatever. But even if that happens, and I'll get into that later, I'll talk about good opportunities, like to sit in some cash and wait for good opportunities when the markets are down. And when you buy good companies at a lower price, you sit on that position for a while, you swing that trade, and you can make a lot of money. And a lot of people have made some pretty good money during 2020. They bought, I don't want to say pennies to the dollar, but the market just went down huge. And more recently, during the whole thing with the tariffs between the United States and Canada, for example, the stock market did go down significantly in the span of a few days. And had you bought like those shares that I'm talking about of good companies, you would have made a lot of money.
Yeah. So would you say it would be a good illustration to say, let's say that a person goes to you and says, hey, I've got this, restored 1957 Chevy, but like right now, I'm gonna sell it to you. Right now, there's like some economic stuff going on, and it's kind of hard to sell at this moment. But I'll sell it to you for $9,000, and like really, it's worth like what, $50,000 or something like that. I don't know. I'm not really big into cars, but I know like the classic cars from the 50s that are restored, they're actually worth a lot. So it's like, okay, yeah, so maybe not a lot of people are out going and buying those right now because of some economic thing, but you're like, man, but probably next year I'm probably going to sell this car for $50,000. It's a pretty good chance, right?
So in essence, when it comes to trading stocks, like very basic, you're buying low and you're selling high. That is the idea. But we're going to talk about this a little bit later about strategies, how to manage risk and how to make this work for you.
Nice, very good. So, is there anything else that you think would be worth telling the people about the basics of the stock market, or something that they need to know as they're getting into this?
Yeah, right off the bat, I would recommend that you just start trading, but not with real money. Open up a brokerage account, through your bank or through, it doesn't matter, Robinhood or wherever you are in the world. Open up a brokerage account and use a practice account with fake money just to get started, okay? Because you can read all these books, you can listen to all these videos, but unless you're actually manipulating, unless you're pressing the buttons and making the orders, you're not really going to learn. It's just like driving a car. Do you remember, Zach, when you were learning how to drive a car? Mm-hmm. Maybe you didn't know how to drive one, so you drove one around the neighborhood a little bit, got some exposure before you hit a major road, and then before you hit the highway eventually.
Exactly. Oh, that's a good one. I forgot about that. Yeah. So something I want to clarify, you said earlier that these companies like Amazon, or these big solid companies, they're more expensive. But just to clarify for the people, like, doesn't mean that they necessarily have to spend more money, right? Like, they could invest $1 into the company to get a little piece of the pie, a tiny piece of the pie. But when you say they're more expensive, like $1,000 investing into Amazon, they're going to get less shares of Amazon, right? As opposed to if they go off of $1,000 to the kids selling hot dogs, they could get 50% of the business, right? They say, hey, I'm going to own 50% of your business, right? Like,
well, that's the thing, because at the time of this recording, Amazon is trading around $234. So yeah, like you could buy one share of Amazon and wait a while until it goes up. But we'll get into this later. It depends how much capital you have to play with. So it would take you about $23,000 to buy 100 shares of Amazon. But you can also look for stocks that are lesser in value. So there are stocks, for example, like Intel Corporation, just to name a few off the top of my head, that are trading for like $20, $30. And then if you have a few $1,000s, you can buy more of these shares.
Nice. Real quick, you made me think of something. So, could you tell the people a little bit about why, and remember, this is just like beginner stuff, but it's like when you see a chart and you see this up, down, up, down, up, down, what exactly is going up and down?
Well, when the markets are open, there are buyers and sellers. Stocks are being bought and they're being sold. And depending on how these transactions go, we as the stock buyers and sellers, we determine what the value of the said stock is going to be during a certain period of time, and and that's a reflection of the chart.
Nice. So also something that I wanted to not forget, today you actually made a trade. We're just sharing this with you. Like, this is not scripted. This is just something that happened. But like, you made a trade today. Can you tell them a little bit about your trade today?
Yeah. So I made a trade today and I made $132. We're going to get into how I did that maybe a little bit later, because that's it has something to do with options. But basically, I basically bet that the S&P 500, which is the top 500 U.S. companies, I bet that the price of that was going to go down, and it did, and I made a profit.
Nice. Now you just got a tiny little glimpse of the gold that is going to be shared with you in the more expert section. So, yeah. Anything else for the beginner section before we move on?
I just want to say, be consistent. There's going to be some hardship. There's going to be a learning curve. This takes time, and we're going to do our best to narrow that time frame. And we're going to teach you like where we went wrong and how to avoid certain mistakes. Don't give up, and try to learn a little bit about this topic every day.
Nice. Oh, and I did think of something about the beginner section. Keep in mind, right, that everything has, like, there's going to be people that will tell you don't get into trading, right? But I actually give the opposite advice to my friends in terms of, like, I say I would rather have my money in a safe, strong company than have it in the US dollar, because every year look at the exact data of how much money you lose if you were just to save your money. Let's say today you have $10,000 in the bank and your goal is to have $20,000 by, the next 6 to 12 months. And like, you're just saving. Every year that it's in the bank, okay, the value of your money, you're literally losing money. You're literally just willingly losing money by having cash in the bank. So I always tell people, I'm like, man, I don't like having a lot of savings. I'd rather buy something, whether it's land or something like that. In this case, you're going to be having your money in and out of safe companies that are strong companies. And if they do have to sit there, like for some reason, like let's say like longer term, holding it longer term, it's safer there in a lot of those strong companies that are going up in value, and later on, eventually, when whether it's a few days, few weeks, or a few months, you'll sell it for a profit, rather than whenever you're like, okay, I'm going to take this $10,000 out of the bank, and you're like, oh, well, when I put it in there, I could buy twice as much, and now I can only buy half. So it's like, yeah, people might tell you there's risk and stuff, but there's risk with literally everything, even just having savings.
Yeah, and on that note, people need to eat, right? They need transportation. They need medical care, right? So that kind of gives you some ideas in what stocks to look for. So if you buy, shares in a company that deals with food or transportation or energy, these things are not going anywhere.
Yeah, nice, man, nice. And we know what we could do is just give a quick. I'll just give a quick like summary for the new person to understand. There are many different ways to trade in the stock market, okay? And like I kind of touched on one a minute ago of like the possibility of having savings where you're holding it long term. That's not really what Ivan's gonna be talking about in this video here, this interview. It's more of mostly day-to-day stuff, so you might trade within it for a few hours, or maybe even start it one day and the next day eventually sell it or whatever. And then And that's just like basic buying and selling. And then whenever we get into the expert mode later on in this video, he touched on a little bit of how you can kind of like bet. You can bet against something and things like that. So that's just kind of priming, your mind to know that there are different ways of trading, and our focus is mostly going to be on the short-term stuff, because that's how you're just constantly making these little profits. And then it's like, oh yeah, worked a few hours this morning, and like in his case, oh yeah, in 1 hour I paid my rent. So are we ready for the intermediate section?
Sure, let's go.
Disclaimer that we forgot to say earlier: this is not your financial advisor, okay? Like, this is just a conversation. Now, he might be saying you because we're having a conversation. This is three friends at a table, okay? Not financial advice, but I'm saying as a third party, what he does is really smart, and we want to share it with you. So let's get into real quick a topic that, I don't know, depending on how you look at it, could be kind of beginner or teetering into intermediate. But you made reference earlier into S&P 500. What is the S&P 500? And well, then I'll have a follow-up question after that. Yeah.
So if we're talking about trading with the U.S. markets, okay, you have to think of it this way, okay? You want to look and to see how the overall market is doing. There is three major indices in the U.S. market. There's the S&P 500, which is the performance of the top 500 U.S. companies, okay? Then there's a NASDAQ, which shows you the performance of mostly tech, like Apple, for example. That's one of the major companies in the NASDAQ. And the Dow Jones Industrial Average, which shows you the performance of the industrial sector. So all those three indices reflect the pulse of the U.S. markets and how they're doing.
Nice. Can a person invest? I'm acting like I know nothing, but anyways, but can a person invest in those top 500 companies in one easy purchase? Can they buy a piece of all of those?
Yes, they can. So if you wish to own a piece of the top 500 U.S. companies, you can buy an exchange-traded fund. It's called SPY. We call it SPY. And you can purchase it. And then you'll be a part owner of the top 500 U.S. companies.
And why is it wise to trade with the top 500 companies in the stock market?
Because then you're going to be well diversified. You're not relying on just the performance of one company.
I think we touched on that earlier. So even though the odds of Amazon disappearing tomorrow are insanely low, it could happen. But what are the odds of the top 500 companies in practically the world, or at least let's just say stock market, in the stock market? What are the odds that they all just disappear and you lose all of your money that you were only going to be investing within a few hours? If you're only going to have it in there a few hours anyways, or a few days, the odds of that happening are so slim. Like literally the odds of the dollar being worthless tomorrow is higher than those top 500 companies disappearing. Anyways, so there's that. What about real quick funds? Like people talk about like ETFs and these funds, such and such fund, such and such fund. Can you give us like just a brief explanation for us that we don't know anything?
An exchange traded fund is basically, think of a basket, right? So the guy that manages it, he has a basket. He takes this company, a little bit of that company, a little bit of this company, and he puts it all into one bundle. And that gets sold to you, buy it, and now you are fractional owner of all these companies.
Nice. So is SPY, as you're talking about SPY, is that a fund?
It's an exchange-traded fund that mimics the performance of the S&P 500, which is the top 500 U.S. companies.
Nice. Sounds good. So next topic, screener. Is that what you're telling me? You were telling me what a screener
Stock
is?
screeners are essentially, let's say you're trying to find something, but you don't know exactly what you're looking for. So it's basically a stock screen is used to narrow down what you're looking for to get you to what you're searching for, which kind of a stock you want.
Nice. So it is a digital tool that you can have on your phone or your other device. Anything else you want to say about Screener just briefly before we move on? I know we can't get too deep into it.
No,
but-
it's all good. There's a lot of free screeners out there. I recommend, well, not, I'm just my opinion, like in my opinion, because that's what I use. I use finviz.com, finviz.com. It's free, and there's a 15-minute delay on it. But if you purchase the monthly subscription, it'll be all live. But it is an awesome screener to use to select stocks and to get a bird's eye view of the total performance of the market.
Awesome. Sounds good. And just a reminder, at any point, if you have any questions or you want him to elaborate on anything, just ask, okay? So let's move on to the next thing. Oh, actually, this is a good segue, is how to pick good stocks. So you're saying this is a tool for helping you to pick good stocks, but can you give some general advice on how to pick good stocks?
Usually you want to pick companies, like again, not financial advice, but just like how I do it, that have high volume. So what does high volume mean? It means that this stock is actively traded. There's money going in, money going out. So if you buy said stock, it's going to be easy for you to get out of said stock because there's a lot of movement. So high volume. I tend to go for higher market capitalization. So I tend to go for larger companies that are established, that have proven over time that they're profitable. Okay. And then we go into price to earnings ratio. So the PE ratio, I know it sounds a bit complicated in a beginner's course, but price to earnings ratio is essentially telling us how much the average investor is willing to pay for $1 of profit of said company. So I try to go for 30 or less, And the other thing that I love looking for dips. When good companies go through a hardship because of the overall economy, their price goes down. I love to buy them at the bottom if I can, but that's not always easy to predict.
Yeah. So what you were just describing a moment ago, you said PE ratio,
price to earning ratio.
Okay. So I know I was having a little bit of trouble keeping up with you because we got an expert here. We're just having a conversation. It's like, yeah. So all right, PE ratio. Can you break that down like even dumber for me?
Okay, so if we take Apple for example, it has a PE ratio of roughly around 32. So that means that people that are buying Apple, they're willing to pay $32 for every $1 of profit that Apple makes.
Okay, and why is that good? Why do we need to look at that?
Well, if you want to be profitable in the long term, this is just my opinion, you want to buy something that has a lower PE ratio.
Okay, so what would be an example of like a red flag with PE ratio, like something that you'd want to stay away from? What would they see and go, oh, okay, that's a bad indication.
Yeah.
I want to stay away from that.
For me, anything over 60, but then we're getting into there's going to be advanced people looking at this video and they're going to say this guy doesn't know what he's talking about, because there's obviously companies that are very hot right now that are going up in value, and they're like for example Palantir. Their PE ratio is well over 650, and people are still dumping money on it because it's a very popular stock. But long-term wise, in my opinion, I'm not going to put my money into those stocks. They're way too expensive.
Cool. And we got to circle back to real quickly something you touched on a moment ago, or a few minutes ago, market cap. Can you give us the basic, simple explanation? What does market cap mean?
Market capitalization is basically, for example, the market capitalization of Apple, it's basically trading at $208 right now at the time of this recording. So that's $208 times the amount of shares that company has made available to the public to buy. Okay, so in this situation, Apple has a market cap of around 3.1 billion.
So let me give a stab at. Tell me if this is an accurate. Let me tell me if this is an accurate explanation. So let's say I have a hot dog. Let's go back to the hot dog stand. So I have a hot dog stand, right? And I say, okay, I want to let other people invest in my hot dog stand. So I'm gonna divide the company into 10 pieces, and I'm going to
Yes.
have one piece, and I'm going to sell 9 pieces. So if I successfully today sell each piece of the 9, right, to other people, and they all pay $1 for it, that means my market cap of the value of the company, my company is worth $10 because that's what people are buying it for, right?
Yeah.
But if I sold those 9 pieces for $10, now I add all that up and I'm like, okay, these 9 people all paid $10. My one share obviously indicates to me that's worth $10 too, because that's what people are buying it for. So now my company, my hot dog stand is now worth $100.
Exactly. That's like thank you for bringing that up. That's a really good example. Yeah.
Awesome.
Basic, yeah.
Cool. So anything else on how to pick a good stock before we move on to the next topic?
For now, we can leave it at that.
Cool.
Yeah.
So again, if you guys have any questions about how to pick a good stock, ask the question. He's going to make a video for you. So let's get into the next one. I'm just looking at my notes right here, right below the camera. I have the notes. By the way, check this out. This is, if you don't have one of these, you have to get this. No, I'm just kidding. So a little teddy bear with all the colors. So risk management. So we don't want to take big risk because people have lost all their money in the stock market.
Yeah,
so
happens all the time.
there's good traders and there's bad traders. Risk management. What do you got for the people?
Before you make any trade, you have to have a plan because things can go wrong. There's things that are going to happen that nobody can predict the future. So let's say, for example, that you have $1,000 and you choose to spend that $1,000 plus to buy 5 shares of Apple. Let's say you decide to do that. You have to ask yourself, are you comfortable in sitting on 5 shares of Apple for the next year? If you're not, and you don't want to have your money tied down, and if you feel like you don't want to take that chance, you can set an automatic order that will sell your position at a small loss should Apple experience a major correction, which means that the price goes down by like $10, $20, $30. So it's very important that you protect your capital and that you have those orders set up immediately after getting into a position.
Nice. Any other risk management things that they need to know?
Yeah, I'll make a video about this later so you guys can actually see it, but make these orders automatic. So set it up in a way that if Apple's trading at $208.85 right now, let's say you bought the 5 shares, set up an automatic order to sell your 5 shares should a price of Apple drop to 200. So yeah, you'll be out some money, but you're not going to blow your entire account.
Yeah.
Automated, essentially, is what I'm saying.
And what is that called when they set those up? What's the technical term?
Stop loss order.
Stop loss order.
And the other one is a take profit order. So what I do, I set up both. So either I'm going to lose 5-10%, for example, depending on my risk tolerance is, or I'm going to gain 5 or 10%. So I set up these orders. I make it automatic. I walk away. I monitor my position throughout the day, but it's better in the long run to have these orders set up for you.
Nice. So tell me if I'm right or wrong about this, just giving an example. So let's say that and this is just simple trading. Remember guys, we haven't gotten into the more complicated stuff, but just simple buying and trading. So if I take $1,000 and I go, okay, I'm gonna buy $1,000 of what you talked about, SPY, which is, it goes up and down with the value of the top 500 companies
Right.
in the market. Okay, so if I put $1,000 in and I bought this stock, okay? Now I can set an automatic thing to where if it goes down a certain amount to where, let's say it's showing, oh no, it's gone down and technically I've lost $20 because the value has gone down, it would automatically sell it and say, it's basically like the most I'm willing to lose on this is $20.
For example, yes.
For example, and I'm not willing to lose any more than that. So I just want to cut my losses. If it goes down there, it's just going to automatically sell. And I say, okay, woof, I only lost $20 on this, but I'm going to try again later. Yeah. But at the same time, I could also, what you were saying, say, okay, but I think that if in the next few hours or a couple of days, if it goes up a certain percentage to where I make let's say $100 profit, it just automatically sells. I'm not trying to wait for it to make me a $200 or $300 because I'm just trying to make some profit here and there over and over again. So I've set it up to where it automatically sells if it goes down a little bit, not a big loss, but maybe automatically sells if I'm up. Is that kind of the general idea of the concept?
Yes. There's another aspect to it that we can get into a little bit later, but I'll just briefly mention it here. We're talking about the stop loss order and the profit taking order. But as the prices fluctuate, what you can end up doing, you can start raising your stop loss as the price of the stock is going up. You can start raising your stop loss to essentially lose less than you would have in your original order.
Oh, that's interesting. So I've actually never heard that before. That's really cool. Because I'm kind of playing dumb a little bit with a video, guys. Like, I'm just thinking to myself, okay, imagine I'm a person that actually doesn't know this term or whatever. So that's why I'm asking these questions. But that's actually something like I just learned right now. I never thought about that. That's cool. Well, before we move on to anything else, the next thing, anything else on risk management?
Final comment would be nobody makes a lot of money consistently in the stock market. There's going to be wins and losses. It's just the nature of the beast. If you can accept that early on in your journey, you're going to be better off. But if you decide to get into this mindset, the price is going to recover, I'm going to make my money, I'm going to dollar cost average. It's when you're putting in more and more and more money into these stocks as the price is going down, you will lose in the long run.
Yeah, good point. And I want to just take this moment to say, without a doubt, if you're trading to get rich, that is a slippery slope. Thank you. Because like he was saying, that's a tough thing to do. It's not impossible. There's people that do it. You probably see the flashy people on social media. It's way more prudent. And plus the greed is really the slippery slope in it all, because the greed leads you to do dumb things, not do risk management, right? And so, again, I just got to reiterate, what he does is just prudent trading. It's just generating an income over and over again every day, mostly making profits with some small losses here. You look at the end of the week, boom, paid my rent and paid, all my food and transportation for the week, and the rest that I'm going to make the next 3 weeks of this month is just, some pocket money. So, all right, moving on from risk management, when to take profits. But remember, we're in the intermediate section still.
Right.
So, taking profits as an beginner to intermediate, what are your thoughts on the subject?
Well, that's going to depend on what your style is. For example, I can just talk how I do it, right? Factor in this, it depends how much capital you're playing with as well.
What's capital?
How much money you have on the account. So, it's going to depend upon the individual. But let's say you have $10,000, you bought 100 shares at $100, right? And that share moves by $1, $1.50. I'm going to sell that, and I'm going to tell you why. You know why I'm going to sell it? Because it's $150 that I can have right away. And that's essentially somebody's daily wage back in North America. Ballpark, roughly, right? Based off of minimum wage, a bit more. And that might not sound like a lot of money back in the West, but if you're living somewhere else where the cost of living is cheaper, that's somebody's weekly salary. So you have to factor that in as well in your decision-making process.
Yeah, and in case you haven't heard, how much are you paying for rent right now? You got a house 1 block from me. How much?
Yeah, it's approximately $85 US.
Yeah. And right now I'm paying $100 a month for 4-bedroom house.
Yeah.
2 bathrooms, which actually the bathrooms, they need to be renovated. They're junky right now. But anyways, $100 a month approximately paying, I think. So anyways, is anything else on taking profits?
There's an old saying, I want to make sure I'm quoting this properly, but it's better to have 1 bird in your hand than 2 in the bush, right? So I'd rather be looking at it than looking for it. So I'll take the $150. Now what's going to happen, as soon as you take that money, that stock is still going to go up. It might still go up, and you're going to say to yourself, I missed out on $300, $400. But by doing that, you're going to you're going to avoid losing like all that money. So suppose the stock turns around and goes down to $95, and now you're out $500, and now you're gonna stay in that position, potentially not cut your losses, and you risk losing even more. So
yeah. And it was so remember we were saying that today he made you had a trade, you made $135, right? But he goes, hey, this is a good modest amount of money. I'm selling it. I'm pocketing that money. But if he would have held on to that for, like, let's say 6 more hours, I'm like, but it could go up more. I could get $250 maybe. Yeah. You know. But what if that wouldn't have happened? What if he wouldn't have just taken that profit, and then it would have went down like he was talking about, and he would have ended up losing $30 or something like that, and he'd be like, oh, I'm so stupid because I just didn't take that profit while I had it. Greed. Yeah. Get greed out of your system, because that is a slippery slope. All right, so next one, right? So we did take profits. Again, I'm looking at my notes down here below the camera. Strategies, basic to intermediate strategies. Not getting into expert mode just yet. What are the strategies you want to share with the people?
There's swing trading. Swing trading is when you buy shares of a said company and you sit on this position for a while, for a week to a few months, and then you collect your profit. Usually that's a bit more of a prudent method of trading, but if you are a little bit more aggressive and willing to take more chances, you can go into like day trading, which is when you buy stocks in the morning and you sell them before the market closes. So those are like the two like basic strategies that I can discuss here. Nice.
Well, anything else for the intermediate section before we get into the crazy stuff? Crazy in a good way. Crazy in a good way. Don't let me scare you off.
Yeah, for strategies. Like I said, if you have a little bit more money, it's a little bit easier to make something significant. So, you know.
That's a good topic for this section.
Yeah.
How much money? Again, we don't want to get into the options just yet, because I know we're going to get into that in the next section. But in just briefly, how much money do they need to have to do kind of what you're doing, like maybe being able to pick up $100 to $150, you know, in a couple of hours?
For example, I just recently opened up a Webull account just for the purposes of sharing some information with you guys down the road. I had $3,000 on it, so you can start off with as little as $3,000 and then see some profit, right?
Nice.
But if you're sticking to, sorry, I should rephrase that. If you stick, that's like, we're going to get into options later. Like if you're going to be trading options, yeah, at least 3,000. But if you're doing stocks, like I would say if you're just buying and selling stocks, $5,000 to $10,000, and then you'll be able to see profits, in my opinion.
Yeah, and here's another thing about this too, is this just came to me, is a lot of people will like see their friends getting into trading in the stock market, like if they're your friends and family that might be super ignorant and super like, you know, scared about doing anything with money. Like you just gotta save and hope that, you know, whatever. They'll try to say stuff like, well, if you're gonna do it, you just gotta be willing to lose it all, and make sure whatever you put in, you gotta be willing to lose it all. And technically that's right. But go back to the point from earlier in the video. If you're investing this, what did you say, $3,000 to $5,000 or something like that? Yeah. Like let's call it $5,000, $3,000 to $5,000. Okay, and you're investing it in this fund that is following the 500 strongest companies in practically the world. You're actually, like I said before, it's like you're actually risking your money more having in a bank that could go bankrupt and crazy stuff could happen, and it's constantly being your value, your money's going down, you're losing money, right? Whenever you have the money in those companies, it's safer. So a better thing of saying like, oh, like because he was just saying like the $3,000 to $5,000, right? I would say don't look at it as, oh, you got to be willing to lose this money. More of, you got to be willing, you have to, this money that you're going to use has to be money that you don't have to have, you don't have to need it like right now, this week, this month. Because there are some situations where maybe, you know, maybe it just stays stagnant for a while and you just or like maybe it's up a little bit or down a little bit and just kind of stays there, nothing crazy, but you might end up like just wanting to hold on to it for a month or two or whatever. Maybe, I don't know, it kind of depends. But the point is like, you don't look at it as, oh, I'm willing to risk this $5,000. You're investing in and out of strong companies. It's just money that you're not going to practically need this week or next week, because you are using it as a tool, a buying and selling tool. I don't know if there's that kind of like more or less the idea. Just you don't need it at this moment, right?
Yeah, like at the end of the day, any trading, any investment involves risk. Like, to not address this is not right. This needs to be addressed. So yeah, things could happen. Like, yeah, you could have your whole portfolio wiped out. Has it happened? I mean, even during the Great Depression, when like the whole market back in the 1920s, when the 1930s, when the whole market went to hell in a handbasket, there's people that actually survived that. A lot of, like 90% of people like lost money, like whatever, people just went bankrupt, but people that held their positions over time recuperated all those losses. So yeah, you could potentially lose everything, but it's very unlikely, because even under the worst of circumstances, historically speaking, not everybody lost everything, because some people knew what to do and how to manage risk and how to apply strategies.
Good explanation, man. So are we ready to move on to the deeper stuff, the expert mode?
Yeah, it's we can do it. Let's do it.
All right, cool. Expert mode, reminder, not financial advice. We are just sharing with you his viewpoints on stuff and what he does, which is actually, in my opinion, again, a very prudent and sound way of trading to make a living, especially if you're wanting to become a more international person. Let's get into the more expert stuff. So options, that's like the big thing here, right? It's not just basic buying and selling.
Yeah.
Let's get into it. All right, go ahead.
Options is at first a very difficult concept to understand. So just for all of you advanced people out there, I'm going to be using examples so that people that don't know what options are can understand. And later I will be putting up videos with examples to be more thorough. But I want you to think of options this way. Let's say that it's the month of August right now, and you decide to walk into Home Depot, okay? And for some reason, they still have snow shovels there. Snow shovels are not very expensive at this time because it is summertime. You go to a manager and you tell him, let's make a contract. I'm going to give you $100. So you're going to give the store manager $100 for the right to buy all of his shovels in that store for $12 a shovel. Okay, so you give him $100. Now, what happens? November rolls in, you're up in the northern states or in Canada, there's a big snowfall, there's a lot of snow, there's a huge demand for snow shovels. So now snow shovels are worth $24 a snow shovel. But because you have a contract with this manager and you paid him $100 for the right to buy these snow shovels at 12, you've now essentially doubled your money by selling that contract to someone else. All right. So in essence, you can either collect all of those shovels at $12 and sell them at $24 to the general public and double your money, or to skip to do all that because it's a lot of effort, you can just take that contract that you had with that manager and sell it to someone else and make a profit.
Nice. And so what's the technical term for that specific kind of trade there?
That is when you're buying a call option.
Buying a call option.
So the flip side to that is November rolls in, there is no snow, there is no demand. The manager of Home Depot decides just to get rid of all those shovels for $6 a shovel because there's no demand and he's trying to liquidate and make more room in his store. You've essentially you've lost your $100. That's it. So the most you can lose is what you put in.
Nice. So very good explanation. So now there's another kind of trade that you touched on, I think earlier in the video, if I'm not mistaken, where you're essentially in simple terms, you're doing options, but you're betting that the value of the stock will go down. So of course the shovel illustration is the shovel is the stocks, right? And you're betting that they'll go up. So now can you explain to us how is it that a person, like you mentioned earlier, you kind of touched on this, can bet against a stock? Like you're betting that it goes down, but then you still make money. Like how does that work?
So let's reference the same example with the shovels and Home Depot and the manager. You're going to go to that manager, like today's July 31st, for example. You go and you tell him, hey man, let's make a contract. I'm going to give him $100 and we're going to sign a contract, and he has to agree to buy these shovels for $12. And he says, but they're already worth $12 and they're going to be worth a heck of a lot more in the winter when there's a lot of snow. And I say, no, that's not going to happen. So he's like, sure, I'll take your $100 and nothing will happen. So he takes my $100, right? Because I have to pay for that privilege, if you want to call it. And then what happens? A few months go by, we hit November, and basically there is no snow, there's no demand for shovels, and the cost of shovels at Home Depot now is at $6 a shovel. And he is now obligated to essentially buy those shovels at $12, and I pocket the difference.
Yeah, crazy concept that you can do this stuff.
It will take a while for you guys to wrap your mind. I'll give more examples, but this is like the simplest way to explain it.
Yeah, but it's cool though, isn't it crazy? Like you can do like the illustration sounds absurd, like walking into Home Depot and blah blah, and these bets that you're betting with a manager. But like the illustration's fantastic because it's like that's really what is happening in the stock market. It's just stuff that you can do with money, and you can buy these contracts and buy the rights to, and you're betting that a stock is going to go up or down, and hey, if it goes down, you're making money. And that's, yeah. Anyway, so now that we're in the expert section, do you want to get into the covered calls?
I want to get it. This is just my opinion. This is like the safest way of doing it. Like options right off the bat are a risky way of trading and investing right off the bat. You risk losing essentially your entire, well, it depends what you're doing, but you're going to risk your premium. We'll get into that later, but you lose what you put in. You can lose as much as you put in. But let's say that you already own the shares. Let's say you owned 100 shares of IBM or 100 shares of Apple. Let's use Apple because it was a recent example. And that is about $20,800 for, at the time of this recording, for 100 shares. You own those shares. You don't really know what to do with them. You're sitting on them. You don't really want to sell them right now. But let's say there was a way that you can rent them. Okay, so the way that works is you would sign a contract with another person. Okay, Zach is going to give me $300. I keep that $300, but I give him the rights to my shares. And if Apple goes to $230, I still keep that money, but now Zach is going to profit from the increase of Apple in terms of price, and he's going to profit all that, and I'm going to get sold out so that my Apple shares are going to get sold at the original price that I paid for them. So I will get that money back. I keep the premium that he paid me, but I don't get to participate anymore in the upswing in Apple. Does that make any sense?
Nice. So what is a premium?
So a premium, essentially, think of it this way. It's like a reward given to you. So Zach came to me. Zach thinks that Apple is going to go up. Okay, and I don't know, but I figure, oh well, I'd rather just see the $300. He gives me the $300, so that's mine to keep. He just paid me. But I relinquish my rights to these shares. So they're still my shares, but not really now. They're kind of in a special account. And Zach will have access to them should the price go up. All right. So now what happens if the price does not go up? Zach is out $300. I still have my shares, but now my shares are worth a little bit less. They're worth, let's say, $200 a share. But I'm not too concerned because I like Apple. I want to hold on to it for the next 5 years. And when the price of Apple goes back to that $208 range that I originally paid for it, I can rent them out again. But this time, let's say Zach gives me the $300 as like a reward or like a fee for the contract. And let's say that we agree to a strike price. Let's say we agree to a strike price of $208. What's going to happen is if Apple goes to $220, okay, Zach is going to profit $12 times 100. minus the $300 that he paid me. What does that give us, Zach?
I don't know, man.
$900. He's going to make $900. But I'm not going to lose anything because I'm going to get the original value of those 100 shares deposited back onto my account.
Nice. What is the strike price, real quick? You mentioned that.
It's agreed upon price. So, you know, that's like we agreed that if, let's choose a round number, 210. So if Apple reaches $210 a share, Zach is getting those shares. He can either take the shares, or what he can do, he can just sell it on the open market and collect the difference. So he'll collect a $2 difference from 208 to 210, which is $2 times 100. So he will collect $200, and he will collect any additional move towards the upside on Apple.
What does upside mean?
That it's increased in value.
Nice.
And I will have, like, as a seller, as the option seller, I have the premium that he gave me, the $300. And when those stocks are sold, I'm going to get my original value of more or less, just for the sake of example, more or less, I'm going to get the original value of those shares deposited back into my bank, into my brokerage account.
Nice. So, covered calls. That's covered calls, right?
Yeah.
Do you think that we could get a shovel explanation of covered calls?
Okay, sure. Let's say you really like shovels and you bought.
I love it. We really like shovels. Okay, we do. Yeah, we
like
really
shovels.
like shovels.
So you decide to buy 100 shovels. You like shovels. You figure I'm going to use these shovels. I like them. But, you know, September's rolling in, fall's kicking in back in North America, and you're just like, hey, you know, I don't know what to do this. Like, I'm not quite sure what's going to happen in the winter. So why don't I get into an agreement with Zach? We do a contract, and I'm going to say to Zach, hey, Zach, these are my 100 shovels, okay? And if you pay me $300, let's say there's a snowstorm, you'll be able to sell these 100 shovels to people for a lot more money, and you'll make a profit, right? And Zach goes, sure, yeah. Like, Zach's thinking there's going to be a huge snowstorm in November, and I'm going to make a killing. Like, why is this guy only selling the contract for $300? But I know, because I did some research, and I know that we're going to have a mild winter because there's certain things happening with climate change, and I did some research. So I figure I don't tell him that, right? So he gives me the $300, and November rolls in, and we have no snow. And basically, Zach doesn't need the shovels because he can't use them. So I pocketed $300 and I still keep my shovels. That said, if it's the other way around and I was wrong, I still have the $300 that you paid me back in July. But now we have a huge, massive snowstorm. And Zach is like, hey man, we have a contract. You told me that you were going to sell me those shovels so I can use them, right? And then I'm going to be out. Basically, I'm going to have to, you know, give him those shovels, but I'm not going to be like out in terms of, I'll be out in terms of the profit potential, but not the original value of those shovels. I'm going to get that money back for the original value of the shovels. I'm going to keep his $300, but this guy here is going to make 5 times, 10 times the money on the profit because he'll be selling a shovel that I bought for $12 per shovel. He'll be selling it at $80, and he's going to collect all that difference on 100 shovels.
Dude, that was an awesome explanation, man. So okay, so in that scenario, who is the one that is doing the covered calls?
I did the covered call. Okay. I rented out the rights to my shovels.
Nice,
yeah.
Nice, awesome.
And I did a covered call, but you were the guy that was buying the call option.
Yeah,
I was the option seller. You were the option buyer because you gave me the money. You paid the $300 for the contract, and I collected.
Nice. And so give us a brief summary again, now that we're kind of starting to wrap our head around this. Why are covered calls kind of a more safer play than maybe some of the other options like, you know, puts and calls?
We'll stick to the basics. Covered calls tend to be more secure because the downside to you is you're going to be owning the 100 shares of said company or said shovels, right? So what can happen is, remember how we paid $12 a shovel? Well, what happens if the market decides that these shovels now are worth $6? Now your entire portfolio is down 50%, but you know that there's eventually going to be a need for shovels. So you're going to sit on something called a paper loss, okay? You're going to sit at a 50% loss on your 100 shovels. A few weeks, a few months go by, things change. Now those shovels are worth, $15. So what do you do when it goes back above the $12 that you paid for them? You sell another call. And there's people that do this on weekly options, monthly options, and they continuously over time collect these premiums, which is rent, which is Zach gave me the $300. And over time that generates roughly, just ballpark, it could be anywhere from 15% a year to as high as 60% a year in profit, depending on how things go. And it's just more secure, more safe if you're getting into options. That's a safer route if you want to dabble into options that are a little bit risky.
Nice. So brief recap on, I'm just going to kind of summarize some interesting thoughts about what we've learned today from Ivan. So you can make money in the stock market by buying and selling shares.
Yes.
You can also lose money that way, buying and selling
Yes.
shares if you sell at a loss. You can make money with other people's stocks that you never bought.
Yeah.
You can bet that a stock is going to go up and make money even if you don't own it, right?
Mm-hmm.
You can make money by betting that a stock would go down even though you don't own that stock.
Yes.
The cool stuff, did I miss anyone? I think that's one of the covered calls. You're also making money on other people's bets, right?
Yeah.
On your stock. So they're making bets on your stocks and you're making money off of their bets. Crazy stuff.
For now, essentially.
Yeah.
And we also touched a little bit about strategies and risk management, right?
Mm-hmm. Yeah. Is there are there any other things we want to talk about in the expert stage? Or is that the main point?
Yeah, options, like we're not going to talk about futures. I don't do futures. I know there's people that are going to be talking, oh, why don't you do futures? No, I don't do that. I can get into that later, but...
Or maybe could you tell us why you don't? Just give us the brief explanation of why you don't, like
they tend to be a lot more volatile, and if you don't know what you're doing, you're losing all your money within a minute or less. Like it's very high risk. But the important thing is for now, stick to the principles, stick to the basics. Open up a brokerage account. Use a practice account with fake money to practice on how to trade. In time, start depositing some of the money into an actual account, and then try to apply these principles that we talked about. If you're still not sure, Zach and I were having this conversation last night. Like, I have no problem repeating myself. I have taught people. I speak a few languages. I've taught people French. I used to give lessons. I have no problem. If you guys have any questions, ask me. And any reservations you have, any concerns you have, we can go through this together, and we can help you through your journey to give you some guidance, based off of our experience and our point of view. Again, we're not financial advisors, but I'll speak for myself. I've made enough mistakes and lost enough money to know better, and if I can prevent that happening to you, that's what I'm here for, and that's what I want to do, to give you value.
Man, that's awesome. One thing that I do want to say that I think maybe we could have said in the beginning is, or maybe the beginner or intermediate area is, don't forget that with trading, there's tax implications. So just with we're speaking primarily with US and Canada, but with just like anything that you buy, if it raises in value and you sell it and you make a profit, you have to pay what's called capital gains tax. So just if you're in US or Canada or wherever you are in the world, there's a high likely chance that that you have to pay capital gains tax. But on the other end, you can also write off the losses. So if you do want to keep track of, get a tax expert, but I'm just giving you the gist of what you need to prepare for this stuff. So also, you keep track of your losses, and your losses on, just like if you sell a car and you have a loss on it, or a house or whatever, that can work in your favor. So you have to keep track of your profits and your losses, and then all of that gets factored into your taxes at the end of the year.
The beautiful thing is, get in the habit of writing stuff down. But your online broker, like if you're using a brokerage account, they'll have that all for you. That's all going to be on your account. So all you have to do is just, print all that out, and definitely talk to a professional when it comes to taxes and accounting. That's very key, especially if you're going to be getting into some larger account sizes in terms of money. Always talk to a professional. Yeah, and I just wanted to add, there's a lot of resources. Yahoo Finance is one of them, finviz.com, just to name a couple. And what I love to do personally, audible.com, you can download audiobooks. I have over 150 audiobooks that I've been listening to for the past 5-6 years while I'm driving, cleaning the house. So every day, focus on learning a little bit more, and over time, you will get there.
Nice. And I have a quick question. I just jotted this down so I didn't forget. You talked earlier about getting a platform where you can trade like with fake money, essentially. The real trades in them, like with real companies, but you're not really making or losing money because it's fake money. Yeah. Do you have any recommendations on like any names of any famous platforms? Because I really don't know, and I'm kind of curious.
Again, I'm from Canada, so and there's interactive brokers. I know they can be used in the States as well. There's Robinhood interactive brokers. There for the States, I think there's Schwab. And all the major financial institutions have like a trading account linked to a bank, for example. In Canada, you can use Wealthsimple, interactive brokers, or you can go through your bank. But here's the thing, when you're going through the bank, like a major bank, the commissions tend to be higher. And when you're going through some platforms like Robinhood or Wealthsimple, which the commissions are lower, but there's pros and cons, right? Like anything in life.
Wait, I was talking about the fake money though.
Oh yeah,
platforms for the fake trading.
Yeah, so when you open up these brokerage accounts, you can easily open up something called a practice account, and you can fund it with like $1 million fake dollars just to get some exposure, right?
Gotcha. All right, we had to go get something to eat. So while our burgers are on the grill in this restaurant right here, we're going to finish off with the grand finale here. So now, Ivan, now that you have walked us through, you've basically led us to this, which is what your average morning looks like when you're trading, what it is you're doing. And so the last few things we've learned about buying puts, betting against a certain stock or fund or whatever, and then buying calls, you're betting that'll go up, and the covered calls. But just go ahead and just kind of walk us through your average day, what it looks like.
Well, usually, when I wake up, I look at my phone, I open up Yahoo Finance. It's what I use, and I have my watch list. Right on that watch list, I have, for example, I have a SPY and QQQ, which is the S&P 500, and the NASDAQ, the ETFs for those. And I kind of gauge how the overall market is doing. I also dabble a little bit into futures. I don't trade them, but I use the NQ for futures for NASDAQ and the S&P 500 to see how the futures are doing, because futures trade almost 24/7 around the clock. So that kind of gives you an idea of where the market could potentially go. And then from that point on, I, believe it or not, I do listen to what other people say. So I'll go in the comment section, I'll have a look what people are talking about, what they're commenting. I'll check out the news, I'll read the articles about certain companies that I'm interested in, and then I will look at the chart. So when the market opens up at 9:30, I'm not going to jump in right away. I'll give it about 20 minutes, a half hour to see kind of where we're at. And then from that point on, I will make a decision. We all have a bias. You have to have a bias in order to trade, okay? So you are going to have a bias, and you're going to have to take a chance, but you're going to have a better chance of making money by taking all these factors into account that I just mentioned.
Nice. So basically, let me ask you this question though. So about how long of research do you do before you buy a put or a call? Like before you decide what you're doing in the market today, let's say we just woke up, and how long are you researching to kind of figure out what's going to happen with the market?
A lot of the research is done the night before. You kind of look where the stocks or the ETFs closed, and then you do your research, and then in the morning as well. So probably if I had to give you like a time frame in the morning, I usually get into a position about a half hour to an hour into trading. So from 9:30 to say 10:30, I'll be in a position.
Nice. So let me see if I can summarize this in a way, and feel free if I'm getting it wrong, just correct me. So you're doing research to find out what the market is going to do. In the S&P 500, the top 500 companies in the market, you're usually, most often, you're trading that, and you're trying to figure out whether you're guessing that today if it's going to mostly kind of go up or if it's going to have bigger movements downwards or whatever,
Yeah, based
right?
off of news events as well. So if we start talking about tariffs, or if there's a major thing happening, or if the chairman of the Federal Reserve is going to talk, those are usually volatile days. And volatility equals cash. Like, you make your money on volatility. You just have to take other factors into consideration with proper risk management to be profitable.
So great. So a common trade of yours would be one of these two things, from what I understand, is you're often trading SPY because it's, low risk of losing your money, but you might take a little loss here or there sometimes. But your common trade would be, okay, SPY, which is tracking the top 500 companies in the world. You're trying to figure out today, do you think that, are you going to bet that it's going to go up, or you're going to bet that it's going to go down? And if you're betting that it's going to go up, you're like, at some point today, go make a decent movement upward, you're going to buy calls, so you profit on it going up. But if you're betting that it's going to make some bigger moves, most likely going downwards based off of news and information, then you're going to buy puts, which is essentially betting that it's going to go down. And if you do that often enough, you're pretty much usually making profit. Is that pretty much it?
Yeah, so think of an elastic band, right? It stretches, and then when you release it, it goes like this, right? The stock market works the same way. Just have a look at the chart. You'll notice certain patterns that, especially if you've been looking at charts for over and over again for many years, you'll notice M patterns, W patterns. So whenever there's a large move, you have to figure out why did this happen. You have to kind of do your research and see why it happened. Right now, for example, this is my opinion, the S&P 500 is trading at all-time highs. It's just normal and natural that there's going to be some profit taking. So when there's profit taking, there's more selling, therefore the price is going to go down. You capitalize on that. We can get into something called the RSI, the Relative Strength Index, that you can look up on your platform, and you'll see when certain stocks and ETFs are oversold and overbought. Now, this isn't a forward-looking indicator. This is like a after the fact. But there's all these little things, little pieces of the puzzle you put together in combination with your bias and your money to make a trade.
Nice. So I want to make sure that we all understand what something that you said a minute ago. Whenever you said that a stock might go up, like it's like a big move up, it's going up. It stands to reason that's probably going to go down because a lot of people that own that stock, they're going to be thinking, oh, it's going up. If I sell, I make money. So what happens when thousands of people are selling their stock of that company that's going up because they want to make their profits, you're going, ooh, but now that's up. I'm betting that sometime later today it's gonna go down, and then slightly, and I'm gonna make a little bit of money off of that, right?
Yeah, so now there's no way of predicting the future. So sometimes this strategy will not work, but more often than not, there's always a pullback sooner or later. I make sure I have enough time on my trades, like enough time horizon, the 2, 3, 4, 5, 6 months out, where I put a few $1,000s at stake, and I can make these profits of $50, $60, $70, $100 within one day. But if I don't make that money that day, I have so much time left on my option that I can turn my day trade into a swing trade.
Awesome. So let me make sure that we understand. Maybe you can clarify this point. So, okay, when we were talking about the illustration, the different illustrations of the shovels, okay, and the things that you could do with the shovels, right? And one of the things you were talking about, like paying the manager $100 or $300 to buy the contract. You're now buying the rights to be able to do that thing
for a certain amount of time
to make that bet. So you can get contracts for a certain amount of time. Can you just briefly elaborate on that real quick?
So now, instead of coming to Zach and offering him $300, I'm going to be, hey Zach, I'm going to give you $1,000, but you're going to give me a whole year, to make my decision. So he's going to collect $1,000 now, but instead of only having, August, September, October, November, instead of only having 4 months, I'm going to buy now a whole year. So now I have more time in case if the trade starts moving against me, I still have time for that trade to reverse, because we talked about it, MW patterns, contraction, expansion, oversold, overbought. Yeah.
Nice. I love it. I think that's about it. Anything last thing? Or are we just going to go eat our burgers?
Well, keep on improving every day, and it's a journey, and you'll get there. And we're here for you if you have any questions. We're going to go eat our burgers now.